Hello, everyone. Welcome to the session. We're about to start in just a moment. Let's do a quick sound check, as we always do before we start the session. Please go ahead and type a quick hello on the chat box. That tells me that you heard me, that tells me sound is good, and that tells me that you're ready. So please do that. We got 40 seconds to go. Thank you so much. Okay, 15 seconds to go. Almost ready to begin. I see your message, Mark. We're going to talk about this in just a second. And it's 1-0. Time to get started with the session. Welcome to the session, everybody. Today is September 22, 2022. My name is Jose Blasco, and this is options trading. So we're going to be looking at the options markets, identify opportunities, discuss trades that we have, and things of that sort. Good to see you, Jeff. Very nice, everyone. Before we get started, I would like to highlight on the upper left our financial disclaimer, as we always do. Please read it carefully. This is important information. Read it completely. This is indeed important, and it's fairly short, so counting on you all to read it completely. Thank you so much. Options with options. You're right, Mark. Options with options. Always learning, isn't it? Good. So the agenda, we'll look at the market, we'll look at the trades, we'll talk about your trade, Mark, we'll talk about trade management, what to do in certain cases. Very interesting exercise today, looking at an assignment. And we'll then look into identifying new market opportunities that hopefully we can execute and get into it. Very good. So we are ready to begin. So let me get rid of the introduction slide so we can jump on top and begin our market analysis. Okay, so we're going to start with the VIX, because again, that's going to be the simplest analysis of all. So let's begin with the VIX. The VIX is currently trading at 28.28. This is the current value for the VIX. Obviously, yesterday was a very relevant day. I know that you had great conversation with Josip about the Fed day and so on. That is the peak of volatility that we went above 30 yesterday as the Fed released their announcement, which was expected by everybody, by the way. And we saw values of the VIX reaching 30. Right now, we are trading at 28 plus. So again, if I zoom out a little bit on this chart, like I've done in prior sessions, but obviously this is on the high side of the chart. This is not low volatility. We are dealing with very decent levels of implied volatility out there, isn't it? So again, later, I'm gonna not later, really. Right now, I'm gonna do the proper analysis of the S&P. We will define if we want to be directional or not, and which direction. And as we do that, then we need to find option strategies, right? Well, the option strategies also depend on how expensive or cheap options are, and obviously with a VIX of level of 28 plus. So the idea would be that selling options is certainly something that will put us as an advantage. Again, not selling options for everything or, out there. We for sure also need to assess the specific condition of implied volatility for the asset that we trade. But if the asset that we trade is high volatility and we sell options on it, and the VIX is also high volatility, so that increases the probability of a mean reversion for implied volatility levels, and therefore those options prices to reduce, and therefore collect an extra profit on selling high value premium and getting the experience of seeing that premium to shrink. Okay, so again, for the ones of you that are part of the sessions every week, this is the normal thing we always do. For the ones of you watching this recorded or newer to the sessions, just keep that in mind, that later you will hear me say, I want to be selling options, and that's why, it's because of the VIX, okay? Now, going back to the SPY, we are looking at the SPY right now, and as we are looking at the SPY, so we can see how this market is falling or has been falling. This is not a surprise, but more specifically, let's look at the auto climate. We are still, like last week when we met, we are still in a down climate that based on statistics was supposed to last by 3 candles. That was a normal thing to happen, 3 candles, but we are now hitting candle number 7. So we are dealing with a climate that is overextended when it comes to its duration, but also its extension. We are, as we speak, reaching a level of 148, where a 2 standard deviation of what we call max distance is 1.07. So in other words, that market is moving too far, too fast, and has been moving to the downside for too long. And those two statements I just pronounced are based on statistics, are not based on a subjective opinion or some sort of a magic guess or magic crystal ball. It's based on statistics. The market has been moving for too long to the downside and has been moving too far too fast. This is basically what we are getting there. So obviously we would expect then a change of direction, and trading to the upside would make a lot of sense. But remember, we always talk about lining up a bit more evidence in our favor and be cautious. And that's why we also add to our analysis the volatility comparison, where we compare in blue color the implied volatility of the the calls, sorry for that, and with the gray color, the implied volatility of the puts. So again, just to bring you back to 1 week ago, we were looking at this market, we were in a down climate, and at that moment in time, we had the implied volatility of the puts above the implied volatility of the calls. That was 1 week ago, and I remember saying, there are sellers in the market, we don't know at which price they are, but there are sellers in the market. So if we get any opportunity to benefit from the price coming close to the EMA and getting into bearish trades, okay, that was the recipe for making nice profits, which happened. But I also said last week that the climate is supposed to last by 3 candles, and if it changes to blue, careful, okay? And then it never changed to blue, and here's the reason why, and that's why I said careful. I said if the climate changes to blue, careful, because we got more sellers than buyers, and we know that because the gray line was above the blue. So why am I talking about what I said last week? Well, because this week we got the reverse. We are now looking at the calls above the puts. So now what I can say is we got buyers in the market. Okay, we got buyers in the market. We don't know at which price. I mean, we could now get deeper into UFOs and things like that, which we will. But just by looking at implied volatility, we know we got buyers in the market. We don't know which price, but there are buyers in the market. So the smart move here is to wait for a change of climate that would be identified with a blue dot. And once we got a blue dot on the climate, knowing that we got buyers in the market, so now my suggestion here from a trading plan point of view, again, not because I have a crystal ball, but just because I follow the rules of my plan, the suggestion would be, let's be happy to be aggressively long, find good bullish opportunities and have no problem of going long. That's what I mean by aggressively long. In prior weeks, we've been non-directional, isn't it? Because we got that contradiction, okay? But now the idea would be to be aggressively long once we get the change of climate. Why? Because we got buyers in the market, and a change of climate would confirm that directional price component. So it means that the buyers are actually already acting. So then we'd find the UFOs to time the entries even better and find those beautiful opportunities to the upside. So start getting ready, start loading the gun, but no time to shoot yet because we are still in a down climate. We need to see that change, okay? We need to align all those various market forces in our favor to have higher quality or higher probability trades, okay? So let's keep that in mind. So I would like to get some confirmation from you guys that the market condition that we have in front of us is well understood, even if it's a quick okay on the chat box or a quick yes, just the letter Y. I won't be too demanding, but please go ahead and type that on the chat box so I know you are with me. This is critical that we understand the market conditions, and please do not be shy. This is a private room at this moment in time, okay? Tomorrow, 24 hours later, this stream will be rebroadcasted, but without the chat box. So this is a private chat for all purposes, and therefore feel free to interact with me. No need to be shy, so I can understand better where you're at. I can help you better this way. So let's interact. Jeff, I closed Lenar after being assigned at a small loss early this week. The funny thing in TOS says the short 100 shares was illegal. I could not open another trade until I closed Lenar. Okay, so we'll talk about that in a moment as well. I also need to answer Mark with his assignment. We're going to discuss those. Those are great conversations to have because this is what happens in the world of options trading. We get assignments, we get exercises, we got messages on the platform. And if you are doing this by yourself, you are by yourself at home, basically doing this, you may be like, okay, what do I do now? What does that mean, right? So again, great points that you guys bring in and great conversations that we're going to have in a moment, okay? Cool, but I can see that all of you are with me when it comes to understanding the market environment, and therefore, in a moment, as we start looking for new market opportunities, okay, so we will look for the type of strategy I would like to find today is going to be iron condors. Why? Because it's too late to go short, it's too soon to go long, and volatility is very high. So I would like to sell options, sell premium, collect high level of premium while I bet on a trading range, because it's too soon for me to get direction and we didn't have the change of climate yet. Okay, and betting to the short side is too late. And on top of that, we got the blue line above the gray, which contradicts being short, isn't it? Cool. So that's going to be the plan for later. Iron condors is what I'm going to be looking for. But so far, we need to review the trades that we have, and that will give me the perfect excuse to go over Mark and Jeff very good questions on the chat box and discuss it all. Okay. So what do we have here? Well, we got Nucor. Okay, we got Nucor. We got the particular, all those various roles that we have been performing week after week after week. If we look at the midpoint of the overall thing, so Nucor shows a specific level of loss at this moment in time. This is the addition after everything that happened before. If we look at this trade on the risk graph, okay, we can see as well the same level of 317.5. Okay, so more or less the same level that we saw earlier on the my position panel. Okay, so now why is it that this trade is suffering at this moment in time? Well, because we went low, we went very low, and we talked about it last week. So that I will not repeat the explanation because we talked about it in depth. Okay, so let's pretend, I know Mark, that you have been assigned on the 125 put that expires on September 23, that one, right? So I need to talk about your very specific scenario, your very specific case, and I'm going to do that in a moment. But first, let's pretend that you have not been assigned, because also you need to know that assignment would happen for sure if it was expiration date, that is tomorrow. But because it's prior to expiration date, so you have been assigned based on a theoretically random process that happens with the brokers, and where some clients may get assigned, some clients may not get assigned, depending on the put buyer to decide to exercise their right to use the put and therefore sell shares at 125, so you get the shares put to you. That process is random. It could happen to this client or that client, and in this case, the client was you, Mark. So that's a little lucky or unlucky, depending on how we think about it, which I'm going to address in a moment. Having said that, not everybody would have been assigned that put, and therefore let's pretend, step one, that you have not been assigned on the put. So what would you do? Well, the thing to do would be the very same thing that we have been doing every single week, which is to look at, do we have distorted Greeks or not? So if we look at September 23, September 30, we look at the strikes 150 and 125. So 125 and 150, right? So we're going to start with the call, okay? So the call shows premium of no bid 11 cents, and we can see the theta is 5. So 5, sorry, I'm looking at the wrong row. Sorry guys, I should be looking at September 23. So if I look at the 150 call that expires in September, we got 9 cents, where theta is showing 32 cents. So it's no way that in one day you're going to make 32 cents where the only premium left is 9. So the Greeks are distorted and rolling would be required. Now, same as you, Mark, I'm reading your second message there about the calls where you never got filled on the call. Notice that in my case, also, I never got filled on the call. Okay, I had a limit order at 15 cents, never got filled on this one. So again, last week, we talked about alternatives on how to work with this trade and change the size of the range. We also talked, Joe had a beautiful suggestion as well. Joe, not sure if you're with us today. Joe had a beautiful suggestion about butterflying. We talked about all of those things, so I will not repeat it since we discussed it last week. But basically, I did not get filled on the September 23. Therefore, I got nothing. So I'm just going to go ahead and replace the order for this order to be executed using September 30. Okay, which if I use September 30, how much that would pay? Well, notice that would also pay nothing, 1 cent only. Why? because this option, this particular stock has been just falling very hard. So we are very far from the 150 strike. Okay, so if I look at new core and we look at this, so notice we are currently trading at 109, right? So we are super far from the 150, and because we are so far from the 150, so we are getting paid nothing. So what should we do for the next week? The same thing. Just replace, either implement the changes that we discussed last week, which I'm not going to repeat this week, or go ahead and do the same thing that we did last week, which is go back to your trading platform. In this case, for execution, I'm using TOS, and change the expiration date with 15 cents one more time. And I mean, since we didn't get filled on the September 23, there is no need to wait for next Monday. You can just get your limit order, good till cancel now. Let me remove any condition here. So submit at right now. Save. Okay, and this will allow me to replace the order now. So I'm just going to replace it. And now I have this new order waiting there with a September expiration at 15 cents, even though the current mark is 6 cents. So again, I need the stock to rally for me to get filled. It's exactly the same case as last week. And this is the right practice, the right thing to be done to avoid or to benefit from those 15 cents if the market was to rally. Now, is it a problem that we see this market crashing like the world is ending? Well, of course, it's a problem. But at the same time, and we talked about it before, okay? We talked about it before, when a market is crashing so far and it's non-sustainable, often we get these extremely fast bounces on the opposite direction. So didn't happen this week. Also, I guess the Fed report is one motivator. The other motivator is that the S&P index is falling, so more stocks are falling. But again, we got buyers in the market. We just talked about it, right? So I would not be surprised that a week or two from now, that market is back inside the range and we can continue massaging the trade the way we should as we are traveling towards the date of the earnings and then its expiration, which is that vertical line on October 21st. So again, this trade, while it's not looking too good at the moment, if we take a picture, it's not looking too good. The reality is that it's looking like many of those trades will look like throughout their life before we get closer to the expiration date. So I'm not concerned. It's not a big deal. It's what it is. So call side, let's have this new order. Let me go ahead and rectify this here. So instead of September 23, I'm going to move it to September 30. Okay. Now, I'm not going to add 15 cents because I didn't get 15 cents. So I'm going to leave it the same way it is. I'm just changing the expiration date to be September 30. Okay. And that would be basically the new risk profile I have. Again, if the stock was to rally, again, we'd be back very quickly into the green zone. Okay. But we need that to happen. If not, again, the most this trade can lose is 459. So again, not the end of the world. But again, we're going to continue massaging. Okay. We're going to continue massaging. So how do I massage this trade further? I need to look at the put. Okay. And we got two cases with the put. Mark case where he got assigned, most other traders that own the put that would still own it. So what do we do if you still own it? We need to look at distorted Greeks. Okay. Do we have distorted Greeks for the 125 put? Yes. We don't even have theta. So the Greeks are distorted. So what would you want to do? You will want to close the put and resell the same put using the next expiration date. Okay. Notice if we do that, we're going to collect a little bit of premium. Okay. Now, not too much given what I can see with the size of the spread. And again, it has a lot to do with the fact that that stock is now getting very deep in the money. Okay. Very deep in the money. And when stocks get very deep in the money, so the quantity of theta you get is the quantity of extrinsic value you get is less. You get more intrinsic value, but you get less of extrinsic value as a proportion. Therefore, the rolls are going to be less efficient. Is that a problem? Well, it's not ideal. Is it a problem? No. Why? Because we have still multiple weeks to keep doing it. We're going to keep shaving a little bit of the risk of the trade. And ideally, if at some moment in time, we get to we get the bounce on the stock I was mentioning before. I was thinking about multiple things at the same time. Sorry about that. So if we get this bounce of the stock to the upside, then the following rolls in the following weeks are going to be very good. On top of that, since the stock has been falling, the implied volatility has been rising, and therefore the rolls we may collect on future weeks are going to be more efficient than the rolls you would collect if the stock has been just boring, doing nothing inside the range. right? So you got pros and cons. Of course, we cannot predict the future. That's why we manage the risk. We now know the most we can lose is 459 on this trade, but we're gonna keep massaging. So the massage today is rolling the 125 put that expires in September 23. And if we do that, it seems that we could collect up to 50 cents. So that's going to be the risk reduction that we could add if we do it now. Okay, so let's do it. I'm just confirming all is good. Yes. Okay, so let's do it. Let's see if I get filled. In the real world, this is a trade where you probably need to go a bit more generous than 50% of the range, because being so far out of the money, I mean, the current price was 109. This is the 125 strike, so liquidity is not going to be the best. And even though it seems that the mark is 62, notice that, you know, even with 50 cents, I'm not being filled. So you'll probably need to, you know, keep trying, be a bit patient, don't rush it too much to get as much credit as possible. But certainly you need to be realistic with the fact that, again, we are deep in the money, so liquidity is not going to be the most ideal in the world. Okay, now your case mark. Okay, well, I'm going to wait for a little bit to see if I get filled at 45. If any, I'll tweak it again later. But your case mark has a great advantage and one disadvantage. Okay, so you have been assigned on this 125 put that is in the money that expire tomorrow. So instead of the put, you got nothing. Okay, you don't have that row on your trading platform. It's not there. Instead, what you have is 100 shares of stock that was put to you at 125. Okay, so what's the disadvantage? Well, the disadvantage is that for you to own 100 shares of that stock at 125, you have a margin impact on your account, which is $12,500. If it's a cash account. If it's a margin account, it's half. Okay, so that money is being tied up. Okay, this money is being tied up. That's the disadvantage. But what's the advantage? Well, the advantage is that you got the shares without paying any commission, and you got the total amount of premium that put had without paying commissions to get out of it, and without suffering the bid-ask spread, which from 1605 to 1560, so we are talking about 45 cents. So you got $45 more than what you would get if you were to roll the trade manually like we do every week. So you got $45 extra and you pay no commissions to be out of the put. The downside is that in your account, $12,500 have been tied up. That's the downside. Okay, so that's the beauty, that's the good and the bad. Okay, now, are you incurring in any additional risk? No. Take a look. So if where is my risk graph here? So if I create a compare spread and I copy the primary spread, okay, and I edit it, and what I do is I add one options leg to get rid of the 125 put, okay, the one that expires in September 23, okay, the 125 put that expires in September 23. If I buy it back, okay, you sold the 125 and you got 405 cents total. If I buy it back at zero, right, that simulates not having the put. And if I add a stock leg, buy 100 shares at the current price 125, that emulates the 100 shares of stock you own at that price. So if I click OK and I show you the risk graph, notice that, of course, because you own stocks, if the stock goes up, you're going to make so much more. But if the stock goes down, so let me move this to the left. So if the stock goes down, and I put my mouse here, notice how the risk of the orange graph, which is the one with the stock you own, and the risk of the blue graph, which is the one without being assigned, notice how the risk is exactly the same. So no issue. You just got $45 extra. You pay no commissions to get out. And the only problem, it seems, I just heard a beep, so we just got filled on the roll for the put. But so the only problem you have is that you got $12,500 of money being tied up. Now, do you now need to wait until October 21st? No. What can you now do? Well, you can get out, Okay, you can get out of that stock, okay, and sell a new put expiring in September 30. Okay, and what is that going to do to you? Well, take a look. If I edit that spread, okay, you get rid of that stock. Okay, and if you get rid of that stock, of course, you're gonna suffer a loss. Okay, you're gonna suffer a loss on the stock. Back to you in a moment, Joe. I see your question. Very, as always, very good points and very good questions. So now, if I get out of that stock now, it's basically the same as buying back that put at the current price, right? So if I do that, I'm gonna lose money. Okay, I'm gonna lose money. But guess what? You're gonna lose money on the stock you own in exchange for selling the 30 put. Sorry, the 30 September expiration 125 put at more premium. Why? Because as the stock went down, what happens to the puts? As the stock go down, the puts gain value. Is that making sense? So by doing that, you are basically going back to the same scenario that I have as I have been filled on my roll at 45 cents. Instead of I have got filled with my roll at 45 cents, to you, it's kind of like you got 90 cents instead of 45. Why? Because you got 45 cents more than me. The pain you had to go through is using $12,500 of your money since the day when you got assigned, which I believe you said it was yesterday, and today, where you're gonna do this change. Okay, so let me document my trade first so I don't get confused and I can store it properly, and then I will show you the steps that you will want to follow to do that, Mark. Okay, so yeah, so let me document this properly. So what I have is I move the 125 put to be September 30, and that pay me additional 45 cents, making my 401 to become 446. That's what I got. So if I click OK, the risk of this trade now, I mean the risk graph, I mean you've seen this risk graph before. We are back to our double calendar, and now the risk of the trade is 414. So again, I shaved some of the risk and I'll keep doing that. Okay, and if it keeps falling, so in the end we'll lose, but it's going to be less than 400 that we're going to lose. And if it rallies back up, we're going to be back in business and we're going to be in a good position to end up with a very happy P&L at the very end. The very end is October 21st. Okay, keep that in mind. So I'm going to copy this. Okay, put it here on the position panel. Okay, keep it here. And now back to you, Mark, with the specific case on what do you need to do now to fix your problem. Okay. So I'm going to explain that very detailed, so you don't get in trouble, you don't make a mistake. But at the same time, also, I want to confirm with everyone that everybody understood what we've discussed, and everybody understood that I am now in that position where I'm waiting to get filled on the September 30 expiration call, and I got completed my role on the puts. So everything is September 30 combined with October 21st for the options I own long, and we keep, working on the trade on its way to October 21st. So if that's understood, please confirm that on the chat box. Then I need to lead a Mark on order execution, so it's on the sequence is understood, and then I'll go take a look at your question, Joe, with coloring it. Okay, with coloring it, and then I'll go for the next trade. So cool. Give me that answer on the chat box, okay? That everything has been understood, please. Now, going back to TOS for execution, okay? So again, your situation here is different than mine, okay? Because, I got the 30 put in September, you don't, okay? Instead of the 30 put in September, you got 100 shares. So what you have basically is you have the 2 long strikes and you got 100 shares long, okay? And what we need to do is we need to leave the long strikes alone because those are the October 21st, so we leave them alone. And what we need to do is we need to get rid of those shares, but you will do that as a second step. Okay? You will do that as a second step. And your first step is going to be, okay, sell the September 30 125 put. Okay, so what you want to do is go out there, pick the option chain, sell the September 30 125 put for as much as you can. The moment you get it filled, you will get that line -1 125 put September 30. Okay, I got paid 16.15. So just get as much as you can, depending on the bid and the ask price. Just negotiate your entry properly, and once you get filled on the put, only then you close the shares. Okay, closing the shares, you can just do that with a market order. Okay, because again, I mean, you may suffer a little bit of a spread, but it's going to be quite minimal. So I would recommend you to go for the put first, because it's going to take a greater amount of time to get the put filled, especially if you want to negotiate your spread well. Remember, there is no need to rush, because while you are long the 125 put, and while you are long the 100 shares, which is what you have now, no matter how much the stock drops, your risk profile is exactly the same risk profile that you would have if you were not assigned. So there is no need to rush, right? So wait until you get filled on the put at the best price you can, and the moment you get filled, immediately close the shares. I would say that closing the shares at the market with a market order is fine. I mean, if you want to be a bit pickier, you can use a limit order too, but I will let you do that. Getting filled on the stock shares is easier, so I guess I don't need to elaborate. But again, the sequence is important. Sell the put first, and then close the shares. For sure, make sure you close the shares. Don't get short on the puts and hold the shares, because then if you get assigned again, now you would own 200 shares of that stock, and you only have one put to protect yourself. So now you would have unlimited risk to the downside. Please do not do that, right? So the moment you get filled on the put, close the shares immediately. You will be like, yes, I'm going to take a loss on the puts. I'm going to take a loss on the calls. No, because you are getting $16.15 times 100 on the puts you're going to sell. So the premium you're going to collect is humongous, because the intrinsic value built in the put is there. Okay, so you get the intrinsic value you are suffering with the stock, plus extrinsic value too. And you didn't have to suffer the 45 cents of bid ask spread, which I did suffer on my roll. Okay, so Mark, please let me know if this is understood, as it is very, very important. Now, I believe it should be understood, so I'll wait for your comment, definitely. But in the meantime, I would like to start answering Joe, because time is passing very quick, my friends. Again, these conversations are fantastic, guys. Okay, and I appreciate so much you guys are putting time and effort into taking the trades and practicing the methods, so you can come up with extremely rich cases, extremely rich questions. So these sessions really are amazing. I'm super happy, but at the same time, it takes a lot of my time. So let me try to be as fast as I can. Okay, so Joe says, why not to color it? Okay, so let me make sure I understood. So this trade is a trade where we own long the 150 call, and we own long the 125 put. Okay, those both expire in October 21st. And on top of that, we own long 100 shares. So your question, Joe, is what about I sell a call above current price, and I take that premium to buy a put, and therefore this is now colored. So if the stock rallies, okay, I'm going to make a profit, and if the stock drops, then yes, I may lose a bit more, but because I have another protective put, this may give me an extra advantage. This is certainly a valid and indeed a smart approach. But at the same time, I want to play a bit with options equivalency here. So if I go back, and this is a little bit of a lecture, but I have to. So if you go back to, and we talked about that in prior sessions, what is the effect of buying a call and selling a put together? This is known as a synthetic. So this is equivalent to being long stock, right? So if that's true, that buying a call and selling a put equals buying long stock, so what is the effect of being long stock, buying a put, and being short a call? Well, let's take two. Either buy the shares and sell the call, or buy the stock and buy the put. I'm going to take the shares and the put. Okay, and I'm going to leave the call alone. Okay, so buying the shares and buying the put. Okay, if I use this formula, is what? Well, if I buy the shares, which is buy the call and buy the put, that's buying the shares, and I buy an extra put. Sorry, this is not correct. Sell and put. Okay? Buy the calls and buy the put. That is long the shares, and I add an extra put. Right. So what happens if I do that? If I buy a call, I sell a put, and I buy a put, what happens? Well, the minus put and the plus put neutralize, and therefore buying shares and buying a put, it's the same as buying a call. I mean, that's basic options, isn't it? If you buy shares and you buy a put, the most you can lose is it's what you pay for the put. If you buy the call, the most you can lose is what you pay for the call. And because of how options are priced, unless there is an arbitrage opportunity, which basically they are almost inexistent, so the extrinsic value of the call and the put for the same strike is going to be the same. So buying shares and buying put is equals buying call. So if all of these things in the circle equals buying a call, okay, if all of this is the same as buying call, and coloring the shares is also made of selling a call above, which that one I didn't use it in the formula. So if I now put them together, the whole thing in the circle is buying a call and the one above is selling a call. So isn't this, my friends, a bull call spread? It's the same thing. So again, if you color it, you're using $12,500 of your money to have a bull call spread. To me, it'd be worth it to buy the bull call spread and then close the shares, because you are in the same position, but you are not using $12,500 of your money. So from a use of your capital point of view, it's way more efficient, and from a risk and reward point of view, it will be exactly the same. Okay, so that would be my suggestion on how to tackle the coloring of the assigned shares. Now, if we want to simulate it, and Joe, please let me know if you are with me on that. I'm just going to create a risk graph. So compare spreads. Oh, you know what? Before I compare spreads, let me make it like the one that Mark has. So, which is what I done before, right? So I'm gonna buy to cover the September 23 put. That was 401. Okay. Buy to cover the September 23 125 put. And if we do it at 0, okay, this is what I've done before. And if now I add 100 shares at 125. Thank you for that confirmation, Joe. So I am back to the risk graph that I showed before. Okay, it's the same risk graph. The most you can lose is what you had there, and if it rallies, you're gonna make a lot because you own shares. Now, what if we color it? Well, coloring it means I'm gonna add two options legs. One where I'm gonna sell a call, and one where I'm gonna buy a put. Now, let's say you do this with October 21st. So you do a color that's going to last until the trade ends. So I'm going to sell a call, and I'm going to buy a put. Okay. Now, which strikes? Okay. Well, of course, the distance between strikes will also make the trade to be more expensive or cheaper, and therefore have more risk or less risk. So if your focus here, and this is a totally different conversation, but if your focus was to be, look, I want to be very, 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 stingy on adding more risk. So maybe you're gonna be like, okay, so the current price is 110, so I'll do the 111, and maybe I'm gonna buy an option at 110, okay, or 109. Okay, so let's see if I buy the put at 109. I'm adding a little bit of risk, okay, but I am also bringing premium in by selling the 111. So let's see what happens if I do that. Okay, so now this would be the risk graph that you get. So if the stock keeps falling, okay, now you're gonna make some money. But if the stock now rallies, now you're gonna start losing money. Okay. Now, of course, if you start varying the strike selection, okay, in this case, notice how the option I sold is paying me 5. The option I bought cost me 580. So I need to pay a little bit net for the color. But on top of that, if I sell the 111 and I got stuck at 125, well, obviously, while I'm collecting $5 of premium, I'm suffering a tremendous, level of pain there, right? So certainly I could make this trade much better to the upside if I was to use, instead of 111, I was to use, let's say, 125 or let's say 126. But before I select the strike for the put, if I select 126, okay, I'm gonna get paid 107 only, because this strike is much higher, and the higher the call strike, obviously the less in the money, the less deep in the money, and therefore the less the premium. So now, of course, I cannot buy the 109 put. That would cost me 5 something. So if I want to find a put which is only 1, let me very quickly look at the option chain. So if I look at October 21st, I'm looking at a put which is like $1. Okay, so $1 is gonna be the 90 strike. So if I do the 90 strike, okay, the 90 strike is costing me 99. Okay, 99. So I get paid 1. I have to pay 99. I get a little bit of a tiny credit. And now, of course, because I got 2 puts, right? 2 puts long. So if the stock was really to fall, there is a moment in time where I make money onto the downside. But what's happening now to the upside? It's going to be very difficult to get back in the green. So again, coloring it or doing a bull call spread, which I'm not going to do to save time, but it would create the very exact same risk profile. It's going to have that problem. You're going to have to be very creative with expiration dates and strikes to maybe find a situation where if it goes back a little higher, you got a little bit of green somewhere here, and you use that as an exit strategy, where if it rallies a bit, you don't trust the trade anymore. If it rallies a bit, you get out, or if it falls a bit, you get out. And again, playing with the strikes will change the risk profile, and you may find a scenario that it's a bit better than what I have on the screen. But the reality is that probably you won't find a scenario that is that much better, unless you get, again, very much creative and you get really on top of this. Bottom line, there's no free money on the market. So again, my approach is we're sticking to the plan. Okay. Again, we started with this trade with $1,000 of risk. If we were not happy with that, the instruction is not to take the trade. If we are happy with that, then we took the trade. And now every week we kept shaving the risk. The risk now is 400 plus. With a few more weeks to go until October 21st, worst case, maybe we lose $200 on the trade, $300 on the trade, worst case. That's a great management. We started with $1,000 of risk. We lose 200, 300. I mean, it's not a happy end of the story, but it's certainly a good trade management. If the stock goes back higher, which is very likely, given how far down it went and what's happening on the S&P, we're going to be back in business, and the outcome is going to be better than coloring it. So not a fan, even though your question is, as always, Joe, very, very good and opens for very rich conversations that hopefully helps everyone to understand better the million, or should say the infinite amount of possibilities with options trading, and therefore opens the door for understanding pros and the cons, and give you choices as you are building your own trading plans, which need to be in line with your priorities and preferences and trading psychology and so on. And these conversations really, I wish I had conversations of this sort on my very early stages of learning how to trade. So thanks, guys, for the opportunity to having this chat, apart from the fact that instead of just talking about a basic call or a basic put, which obviously it's nice, but it's a bit boring, if you wish, you guys gave me the opportunity to get deeper into very rich conversations. So thank you for that, and please keep doing it. Next trade, IBM. And by the way, anyone, and especially Joe, since this was your question, if you have any additional comment or suggestion or anything, for sure, and no need to say, feel free to share. Okay, I'm happy to do it. You got 1620 on the put, very good. So now the next action then would be to close the shares, and then you would be left with the same I got, and same risk profile and same everything. Okay, so good one. IBM is the next. Wait a moment. LEN for Jeff. I mean, we don't have LEN anymore because that trade concluded last week. But before I get into IBM, I need to bring some support here for Jeff. So let me read your message, Jeff. Sorry, I almost forgot. I closed LEN after being assigned at a small loss early this week. The funny thing in TOS, okay, let me get the chart as well. So LEN was a trade that was a butterfly that then was massaged multiple ways, that then was converted into an iron butterfly. And the last week, in my case, gave that little window of opportunity to end up with a profit. Okay, the stock closed just a little above, okay, on expiration. And again, depending on all these massages on the top that you did, and if you kept the butterfly until the expiration or not, so you may have got a sign or not, it may have been a profit or a loss. In your case, it seems that it was a tiny loss, so good job. The funny thing is that TOS says that the short 100 shares were illegal. I could not open another trade until I closed LEN. Got you. So why could a broker set or tag your trade as illegal and kind of get your account frozen? So there are a few the possibilities that I've seen. Also, this is terminology that, while it's quite normal, it's also a bit specific to brokers, and a broker may call something illegal that another broker doesn't call illegal, or maybe something is illegal based on broker ABC, depending on the type account that you have, where if you were using the same broker but you have a different type account, a different account type, then they don't call it illegal. Okay, so again, these situations, I would say, as a rule of thumb, it's a great opportunity to learn about your broker and always get into a conversation with the trade desk. With TOS, it's super simple and, to be honest, very nice. You can get into the support. Okay, so you just click here and you get chat support. You got live support. You can create your support ticket. When you create the support ticket, you just make sure you direct it to the trade desk, so you can talk about, hey, what's going on? How do I fix it? Why did it happen? And you understand better your broker and your situation, so you know what it is. But I would say that there are two classical cases for this to happen. And this happens to the majority of brokers. And they call it, the majority of brokers will call it illegal. So you don't need to respond what your case is, Jeff, unless you feel like it. Remember, the chat is private between us, but you don't need to respond, okay, because it may be personal. But the classical cases are, you got a sign, either long or short, whatever it was. In your case, it was short, but it could be long too. And there is not enough capital, okay? So not enough capital to be assigned, right? So then what happens? You are in the process of having a margin call, which some brokers execute speed of the light and they close you automatically. Other brokers give 1, 2, 3 days to give you the opportunity to bring in capital to the account. Again, different brokers deal with these situations differently. But not enough capital could be a reason for a triggering condition of illegal, what they call illegal, which is such a strong word. So what do you do? Well, you just close the stock shares, and then you free up the capital, and then it's not illegal anymore. Okay, so that's one case. Another case that often triggers that condition is the Pdt Rule. Okay, the Pdt Rule. Okay, the pattern day trading rule. Okay, so pattern day trading. Okay, pattern day trading is basically the consequence of a specific law that is set and applied all brokers in the US, where if your account has less than 25K, okay, this applies to equities and options on equities, not to futures or options on futures. But if you have less than 25K in your account, then you have limits on how many trades per day you can open and close. Okay, so open and close is what is called a day trade if you do it during the day. So typically, if you are under 25K, you are limited to 3 of those. If you've done 3 of those during the day, you've entered and exit during the day, then you cannot do anything else. Your account is locked. The only thing you can do is close trades, but you cannot open trades. That's another condition that often brokers will call illegal. Again, not every broker is the same. And by the way, this is important because, for example, when you do an iron condor and you have 4 legs, this counts as 4 trades. So, and this has to do with day trades. Day trades means you open and close during the day, right? So if you have an iron condor in your account, and let's say you did a roll, for example, that's 2 units, right? One was a trade which is closed, it doesn't count, but the second is a trade that is open, so that one counts as 1 trade. If you try to do an iron condor, that's 4 units at the same time. So some brokers may have a concern, which is, okay, well, this guy is entering 4 trades. They are not day trades because the guy didn't close them yet. But what if the guy tries to close the iron condor after entering the iron condor? Well, that may trigger an illegal condition, because while you haven't done anything illegal, the broker is trying to protect themselves, and they don't allow you to do it at the same time, right? So, or maybe you just want to do a roll which is only 2 units, but maybe you had an assignment, or you close another trade or something like that, and they're counting that as a trade, and again, they make you fall into this pattern. Again, not every broker treats this the same way. That's why I'm being a little bit subjective on what I'm saying here, which is not really my style. I like to be very concrete, but because each broker treats it slightly differently, that's why I made the comment that when this happens to you, the best thing you can do is click on the chat room box, go talk to the trade desk, find out exactly why this happened to you, so you know next time what to do to avoid it. Or maybe it happened, it's not a big deal. Like, for example, if you are facing a potential margin call, but you're gonna exit the trade 2 minutes later, who cares? I mean, personally, I'm not bothered by that. But which, again, would not be recommended in any case, because you should never get into a potential margin call situation. You should never get into a position where you don't have capital to assume certain possibility in your trades, because that opens the door for excessive risk. So you should never be in that situation. But again, if you are doing something that is going to use a lot of the capital, and you are just doing it temporarily, and then you're going to be out of that, and for example, you got the advantage Lamar got 45 cents extra because you got assigned, that doesn't bother me. Even though in many trading books they will be like, oh my God, assignment, crazy thing happened to you. Well, no, it's not necessarily a crazy thing. Illegal order, oh my God, that's illegal. Not necessarily. It may just be broker terminology to kind of create a little bit of discipline on their clients and scare them a little bit, and they use strong words on purpose, but it doesn't necessarily mean that the world is ending. Okay, so that's my 2 cents about what happened to you. But in any case, well done. You closed it. The loss of the trade was limited, so good job, Jeff. I would say, unless you have any other concern, I would say that's it. IBM, a quick one. Okay, so with IBM, we don't have anything to comment. The trade is working according to plan. We are inside the purple area. Statistics suggest that if we cross the purple line, it's going to be after the expiration date that concludes our trade, which is that purple line, that dotted line. So far, all looking good. Nothing to be done. Probably we'll get into next trading week, and if anything needs to be done, it's going to happen next week. Hopefully not, and this trade will be a full profit. And Amazon, and I'm looking at the clock, we need to do rolls here, and we're going to be running out of time, so let me do this quick. So Amazon is suffering the same condition as Nucor, in the sense that it went down, down, down. It surpassed the purple line, which is our 121 strike. It's currently trading at 117. Yes, 117. So we are in the money. The put is in the money. Okay, now it's not too deep in the money, so we can certainly do the roll. But the one thing that is probably suffering is the call side, where we may not get enough premium, and we may need to do the same thing we did with Nucor. So let's take a look. I'm going to bring in the rich graph so we see what we've got in our hands. I'll take a sip of water as well, if you don't mind. So this trade with Amazon is only losing $70 per contract. Okay, so it's not too big as a deal at the moment. If it bounces, we're going to be back in the green very quickly. But again, let's take a look at the option chain. Let's look at this expiration date and the next one, 23 and 30. And the strikes we're using are 121, and 139, if I'm not mistaken. So let me double check. I did this right. Ahmed, good to see you, my friend. Late is better than never. And then you have the recording, okay? Remember, you can always, on the upper side of the stream, you have this share arrow, so you can share and copy the link, and then when the session is over, you can go back and watch the beginning of the session, okay? So you can do that. Anyway, I was going to confirm or reconfirm that 121 and 139 are the strike. Yes, they are. So did I float? Interesting. Novice move. Like I never used top before. I guess I closed the option chain. I don't even know how I did that. So Amazon back to one strike. So now I know for sure we are dealing with the 129 and the 139 strike. And we are looking at, are the grids distorted or not? So on the call side, we're talking about 1 cent. There is no theta. Certainly we want to roll, but here's the problem I was mentioning. Okay, so the call side only pays 4 cents, 3 cents. Okay, so no good. So the action here with the call side is exactly the same action that we had with Nucor last week. In this case, it's going to be with Amazon this week. So looking at Amazon, we are looking at September 30, we are looking at the 139 strike. We are looking at selling this at 15 cents, if possible. We cannot do it today because we still have one short call. So I'm going to have to do a good till cancel order with an activation rule to trigger the order next Monday. Okay, so submit at next Monday, which is the 26th. Okay, and we'll do something like that, 933, something like that. Good enough. And that's it. Confirm and send. And that's it. Okay, so I got the Amazon option there waiting. Okay, cool. Just like the Nucor call is also waiting. What about the puts? Well, the put is the 121, and it has a theta value of 34 cents. Okay, so you may look at 34 cents, and you may look at $4.55, and you may be like, okay, no, that's great. It's all good. Let's leave it like that. Well, no. Okay, why not? Because look, if we do the math, so let me bring a calculator here. So the current value of 116, current value of Amazon 116.72, and the strike is 121. So this option is in the money by 4.28 cents. 4.28 cents minus the midpoint, okay, that is 4.425. So that tells me that we got 14 cents of intrinsic value. Extrinsic value, sorry for that. So 14 cents of extrinsic value, where theta says we're going to make 28 cents a day on time decay. No way. It's impossible. So the Greeks are distorted, and therefore we should be rolling the 121 put. So let's do it. Okay, so 121 put. Let's roll. So roll from 23 of September to 30 of September. And that is supposed to bring $1.20 of credit in. So let's do it. And we just got filled. We got filled at 120. Wonderful. So if I go back to the risk graph, okay, this is our risk graph. So what we've done so far is we've taken, this is a trade with $648 of risk. So what we've done is we've moved the options to September 30. On the call side, I have not been filled yet, but if I do accomplish my goal, my 54 cents will be increased by 15. Okay, so that would be 69. Okay, and on the put side, my 121 would be increased by, did I say 120, right? Yes, 120. So that means that this option would be, so 20 is going to make this to be 18, and this is going to be 3. Okay, so if I do that, my $648 of risk now becomes $513 of risk. Okay, the P&L is still the same, minus $70, but we just added more premium, therefore reduce the risk. And as the stock goes back higher, we are back in the green area. And ideally, as it goes back higher, we will also get filled on the call side. Okay, so this is valid. I'm just gonna copy and paste it on the positions panel. As we are concluding the session, I see one last question here from Jeff. Okay, so we'll close this. Lots of trade management today, guys. But again, very good conversation. So Jeff, can roll the call to the 130? Okay, well, right now, I would say it's too soon. Why? Because, I mean, we have this line crossing the red line on the expression. So to be honest, you can start doing it. Okay, you could start doing it. But yeah, so since the week is about to end, I would maybe give it just a bit more flexibility, especially also, and this is the key, we are inside of a green UFO, right? So this may go back up. So, no need to change the range unless it's really needed. So I would just give it a little bit more of a breather and decide then. But let's say it falls a bit more, right? And you decide to do it. So then what you would do is, instead of this red line, so what you would want is to draw a new red line from here, okay? And then, recalculate the range based on that. So now the size of your range would be this. Then you would calculate what is the upper third now, and probably the upper third, instead of 139, I don't know, maybe the upper third now would be that price level. And now here you may get a bit more premium, okay? So I'm not sure if that would be 130. I will need to do the math, but that would be the process to use. And then you could certainly roll to the 130 strike. But notice, if you do that, like I mentioned last week, you will need to roll not only the short 139 to become 130, you would also need to roll down the 139 call to become 130. So everything long and short becomes 130. Okay, long 130 call and short 130 call with two different expiration dates, but both will need to be moved to 130. Not only the short option, also the long option needs to be taken out and rolled down to 130. Okay, so anyway, my pleasure as always, guys. We'll let you go now. See you next week. As always, keep up the good work. Again, amazing question. I always feel a bit bad, as you know, if you know me well, that we didn't have a new trade in. I love to get new trades in because it's opportunities to do what we've done today. But at the same time, it was very good conversations, guys. So keep up the good work. Love it. Good to see you, Lilan. And we'll see you soon, everybody. Take care, my friends. Bye-bye.